Good evening, everyone. I've just realised the camera is over there rather than on my laptop screen. So, good evening, everyone. My name is Simon Misiewicz.
And my name is Louise and Simon Misiewicz.
And thank you ever so much for joining us tonight talking about property and business tax. And this is where you could ask your questions, and it is our opportunity to provide some answers to you this evening. But before we kind of go through your questions, so if you do have questions, it is live, so please feel free to type those questions, whether you are on YouTube Live, whether you are on LinkedIn, Facebook, Twitter, it does not matter. You can put your questions on and we will answer those live tonight. But there was some exciting news. What's that exciting news today, Louise?
Well, we are basically filming directly from Spain, so hello Spain. And the reason that we're in Spain is because we have been growing our property portfolio business. And we took acquisition today of a beautiful apartment out towards Marbella, ready for our furnished holiday let business here in Spain. So we have broadened our horizons, so to speak, on our own property business, and we've now started up our own FHL over in the beautiful Marbella Costa del Sol. Anything you want to add?
Why have we started to invest it? Sorry, I'm just getting the chat box open and available. So whilst I'm doing that, I'm just going to leave you to Louise for a second, just to stall you. But ultimately, why have we chosen to have a holiday at home in Spain?
Well, this is the first of what we hope to be a small portfolio. We've been doing a lot of research on the kinds of property businesses that we might want to expand our property activities to. So what we've historically done over time is we've tested different marketplaces, be it HMOs, be it single family lets, be it what I would describe as almost mini hotel facilities. And we've removed the ones that didn't really provide the profitability that we wanted. And we've retained and grown the portfolio in the areas that we did want. One of the areas that we were really, really keen to try, but didn't feel we had the environment to do it the way we wanted in the UK was furnished holiday lets. And we've been doing a lot of research into different parts of the world. And we felt on reflection that this area in Spain would be ideal because it has very large, what we call shoulder seasons, Simon and I, which means it's not just that summer season of July and August. There's a lot of interest to expand it. Plus, the location is ideal both for old and young. It's ideal for sports fanatics, being only a 2-hour drive away from Sierra Nevada for winter sports. It's only a 10-minute drive to the beach. And it's smack bang central between about 5 different really prestigious golf courses. So we're catering to a very wide audience, but always we niche in. So we're looking for particular types of clients out of those groups, possibly for the entirety of the year. And we're satisfied there'll be enough demand to make it very profitable and also, quite frankly, a lot of fun. We have a passion about tax, we have a passion about property. And we want to continue to maintain those passions. And so for us, finding the right kind of property business, one that we're going to love and embrace and have great fun with, is really important.
So what we are going to be doing in the next upcoming shows is breaking down some of the things that we know helps you to become a professional service apartment provider that makes as much money as possible. So we've done a lot of research already. We're going to be doing this in practice so you can learn with us, talking about not only having service accommodation, service apartments, but we can have those in a different country. And there are going to be some trip ups along the way, but it's our opportunity for you to kind of learn with us so that you don't have to make those same mistakes. So when you see us making mistakes, please don't point at them and go, "Oh, you amateurs." Do try and use it as a learning curve for what not to do for you as well. So we'll be open, transparent about all the things we'll do in the next up and coming shows. I am going to go to, before we go to our Q&A, there's something that I've been meaning to do in these sessions for an awful long time. I want to express that this is about business owners and business investors, as well as property investors. Okay, so there's many categories of people that I want to come along this show, ask their questions, and then get as much out of this session as possible. But I set a challenge to myself and Louise to find out how much money you can make tax free. And we are going to break it down piece by piece. And we estimated that we think you can earn over £40,000 tax free. That's fair to say, isn't it?
It is. And it's not using pension allowances, charitable gift aid donations, EIS and SEIS allowances. None of those have actually even been featured in this £40,000 plus tax-free allowance. In fact, what we've done is we've used all the allowances that everybody can use on a day-to-day basis, and we're going to break those down in this session.
So why don't we start that process now? So we talk about tax-free income first of all. Mm-hmm. So the first tax-free income is £1,000 worth of property profits that you make. So if you earned 1,100, how much would you tax?
Well, depending upon what personal allowance you've used up, you're actually only going to be paying tax on £1,000 of that income.
Yeah. And if you have £1,000, you have tax-free income from that property. So we need to think about, well, where else can we earn this kind of tax-free income? Self-employment. I love the American tax shows. Mark Kohler talks about always having a side gig. So, Mark, not that you're going to watch a UK show, but this is testament to who's to say, Mark Kohler, you might be listening out. I might have a shout out, and then it's now going on to YouTube or through the algorithm. Who knows? But £1,000 worth of self-employment income could also be tax-free. And the kind of self-employment activities you could have is selling products on Amazon. I see that being quite a popular choice. You could sell your services. I have to be very careful of how I describe that. But you could sell your business services, let's leave it there, where it could be tax-free. You could be selling other products. So you could be affiliate marketing, or you could do a number of activities, which on self-employment will be tax-free if you earn up to £1,000 profit. It isn't income, it's profit that you can get. Any comments on that one, Louise?
No, in fact, I was just going to go back to the £1,000 worth of property, because you might be saying to yourself, well, I don't own a rental property, so how am I going to earn property profits? It doesn't have to be just property. You could have shares in a fishing lake and earn rental income from that. That would be classified as property. You could have land that you happen to lease out for, I don't know, clay pigeon shooting or something like that. It doesn't have to be a physical house. It's about earning rental income from land or property. So hopefully that widens your expectations. Car park space. Do you rent out your car parking space at your home because you happen to be local to either a great shopping mall, or you happen to be close to airports or something like that, and you rent out your driveway? I know that's a very lucrative way of earning money too. So anything like that could easily be property.
I guess in terms of what we're doing, if we just do property and that's all we had other income streams. But if we only had £1,000 profit, then that too would be classified under property, wouldn't it? So that £1,000 would be tax-free. So it's worth thinking about. The other kind of form of income that will be tax-free is £6,000 worth of interest. Where can you earn £6,000 worth of interest? Surely you need £6 million in this day.
Pretty much. We're going to get that interest from a bank account. No dissing out good UK banks, but based on the current interest rates, I'm afraid you're going to have an awful lot of money saved up. And quite frankly, it's probably not going to be very efficient use, never mind the tax efficiency. But what happens if you're a director of a limited company? What if you've lent money to a friend? What if you have lent money into a crowdsourcing fund activity and you're now earning income by interest? All of those are interest amounts, and therefore could add up to this magic £6,000. Now, there are always caveats and conditions to these numbers, and one of them to do with such interest is that the other types of income you're earning have to be in a particular category type, and we can describe more about that. It doesn't mean you can't earn that 40,000, including the 6,000 interest. You absolutely can. But you really need to talk to your tax advisors and accountants about what could trip you up if you're not too careful. What else?
So we're obviously going to be focusing on wages and dividends. So you could have a part-time job. We shouldn't dismiss that. Jim Ryan always talks about, I know that I see so many people that are so eager to give up their jobs and to start their business or their property business. And I think that's a mistake. I think that until your profits from your business or your property exceeds what you have from income, then I don't feel that you should leave your job. So please don't be rushing into that. There's a lot of people that will say, give up your job, give up your job. But we have seen many people whereby they've given up their job, try to make it in property, try to make it in business, and then have had to swallow that bitter pill of going back. So please don't just jump straight out of giving up your business, your job, just to start up any form of business. Always take your time, always earn the money. And that sometimes means that you could go from full-time to being part-time.
A lot of accountants do that, and that's a really lucrative way to release and relinquish some of that hard worked full-time back into growing your own personal business activities and portfolios of perhaps even property. Part-time is a great solution. It gets you starting to get you out the door, and also gets you used to having a very different lifestyle and a different working plan around the things you're going to do once your job's gone.
And the other side of that is that your employer might want to keep you, even if it's on a part-time basis, and maybe pay you more per hour, if you look at it pro rata, then you are employed full-time, because they don't want to lose you. So it could work in the negotiation. And the reason why I mention that is that if you have a job and you have a limited company which has profits and you want to extract money out of the limited companies as much tax-free as possible, £2,000 worth of tax-free dividends may be pulled out. But if you use a good combination of wages and dividends, then you could take out for your limited company using wages or even from a part-time job, let's not forget, you could earn £14,570, which is again a combination of wages from your limited company or your job and dividends. Okay, so as long as you go with those bands, that'd be totally tax-free.
And it's a great solution to extracting money carefully, frugally, but tax efficiently. So don't let that one go, quite frankly. It's a great solution.
Yeah. And the other side to that is looking at things like rental room allowance. What's a rental room allowance?
Wow. And this is on top of the £1,000 worth of property income that we previously described. So rent a room is literally what it says on the tin. You rent a room. It's about basically renting out a room in your own home to a lodger. So that lodger needs to access most of the utility spaces, so kitchen, lounge, etc., alongside you. They need to be able to enter and leave the same property as you, uninhibited in terms of having their own key to get in and get out. But you can actually earn up to £7,500 worth of income from that rent, completely tax-free. You won't even have to put it on your tax return. You may need to tick a box to say you've earned it, but up to the first £7,500 worth of rental income per property. So if it's two of you, like a husband and wife, say, and the property and you're renting out to lodger, then the maximum you can have is £7,500 on the property. If you happen to own a property on your own and choose to bring in a lodger, it's still that £7,500, which I think is really wrong in many ways, but it is what it is. But I won't say no to £7,500. Thank you very much.
No. And again, what we're trying to show to you is that it's sometimes broadening your horizons in terms of, I think there's Rob Moore who's doing a show called Multiple Streams of Income, but multiple streams of income, which is tax-free. So really, it's a great opportunity for you to think differently, to maximize your income streams whilst paying the minimum amount of tax. And that certainly can help you do that. So those combined, let's just summarize what we just talked about. So we talked about £1,000 worth of property profits, £1,000 worth of self-employment income, £6,000 worth of interest, which could be from your bank account or your own limited company.
Or a combo.
14,570 wages and dividends, 7,500 rental room allowance. So you could earn legitimately £30,070 tax free.
And this is in tax year 21-22 as well.
So that's a phenomenal amount of money. So when people say that you can earn around about 12,500 tax-free, not true. You can earn more than double that. So it's really your opportunity to say, well, if I want to earn money tax-free, how can I do that? And there are, again, just broadening your horizons to multiple streams of income. This is a fantastic way of doing that. But there's more, isn't there, Louise? What else can you do?
Oh, there's a really lovely little amount that most people forget about every year, and that is your capital gains tax allowance. So it's something called an annual exempt allowance, AEA, and it's not to be confused with your personal allowance either, your income tax personal allowance. It's a completely separate allowance, and that adds up to a whopping £12,300 currently per year as well. So in other words, the first £12,300 of tax-free capital gains that you have won't cause you tax on top of all that lovely income you've just described.
And let's not forget, I mean, if you add the £30,000 that I broke down earlier, plus the 12,300, gives you now a tax-free income level of £42,370.
That's not to be sniffed at. That is a
That's
very
huge.
good amount of money. And the majority of it's going to show on your SA 302. And for those in the know, an SA 302 is a document that most mortgage brokers and lenders are going to want to get their greasy mitts all over to assess you for your money's worth in order to determine if they're prepared to lend to you. And that could be important, particularly if you're looking for your own home or you're looking to grow your own businesses and you need cash. So tax-free and showing on your SA 302.
Yeah.
Amazing.
And not only that, but if you're a husband, wife, civil partner, double that, and that gives you now £84,000. When typically we look around the country and people say that the average salary is £25,000, which is taxable salary at £25,000. We've just described a way of husband and wife, civil partners, earning £84,000 tax-free.
And it doesn't even have to be, as you just described, it could be simply two people living together. So you don't need to be married,
No.
you don't need to be in a civil partnership, but you could be bringing £84,000 between you, completely tax-free. Happy days.
Yeah, absolutely. So I hope you don't mind, guys, as breaking this kind of news feed into this channel. It's really about your questions, but I did want to talk about that. I'm going to ignore that question for now, but so we've got Jason, who's asked a question about, question relates to service charge for apartments. Funny, now should we talk about apartments?
Amazing.
Here we are. My service charge was £1,792 and fully paid up for 2020. However, I came into a sudden surprise that a deficit had been applied to my account by the developer management company due to an overspend on the budget. And I gave some other details, but we don't need to go to that. But I do think we need to focus on the point of you have an agreement with your as a leaseholder. So there are two parts to a building. There's a freeholder that owns, I would say, the out parts of the building, and then there's the leaseholder that owns the innards of that property. And the freeholder's responsibility is the maintenance and the upkeep of that property. And if you've got shared gas, utilities, etc., they might have to do that as well. But if they've got an overspend, then it's an overspend, isn't it?
Well, all I will say, Jason, is go check your terms and conditions. I think you may have already done so from some of the additional detail you provide, but just go double check them. Because what I tend to find in a lot of service agreements, and I'm no lawyer, firstly, is that there's always a get out of jail card free by the service management team, whereby they'll say, we've set a budget, but it is exactly that. It's a budget. It's not actual numbers. It's not real numbers until we get to the end of the year and we toss everything up and go, oh, look, we spent perfectly to the budget or above it or below. And if you go above it, unfortunately, you're going to be on the hook for a portion of it. If you've spent under, well, fantastic. There's a little bit left over and that will just be added to the budget pot for next year, which might mean you end up paying less on your service charge budget payment for this time next year. So I would say go have a good look at your terms and conditions. You might find in there, like I say, they have a get out of jail free card. If your terms and conditions make it very clear once the budget is set, that is it, and they can't overspend, and if they do, it's their responsibility. You might want to bring that to their attention, and if they don't listen very well, you might need to get your solicitors involved to help you.
Very good points. Very good points indeed. So hopefully that's helped you with that. Max, good evening, Max.
Hi, Max.
A frequent person on this. And Max is giving a subtlety that it is way past his bedtime, that he won't be watching us live.
What?
So hopefully by this time...
Max, wherever you are in the world, I
Hong
hope
Kong.
it's amazing.
He's in Hong Kong. So that's why he doesn't watch these shows, but he does say that he's going to watch them in the morning.
Okay.
So there you
Good
go.
morning, Max.
Good morning, Max, when you do watch this show. So I lent 250,000, and I'm assuming here he's got dollars, Hong Kong dollars, which is $10 to every pound. So £25,000, okay, to my company to fund a property purchase of a rental. If the company was to repay me monthly using rent received, to say rental income of $1,122 here again, but I guess it should be about pounds here, and paying back the direct £1,000 plus £50 interest. What is my company's position on this? And that's a very good question, because we described earlier, haven't we not, that you can get £6,000 worth of tax-free interest in the UK, and I'll mention that there's a good reason for that. So your limited company would pay Max, in this example, £50 worth of interest per month, which it can do because he's got a loan outstanding, and then pays him the £50, which technically speaking will be below his tax-free allowance, depending on other forms of income, we have to note. But there is one document that you have to do for as a limited company owner. What is that document if you want to pay someone interest?
Well, you have to, as well as obviously putting together a loan agreement. So I'm presuming here, Max, and forgive me, big assumption, it's what you're describing is, whilst you say you lent the company money, what you mean is you put a director's loan in place. I would expect there to be an agreement between you as the lender and your limited company as the borrower to say what it is that's been borrowed, for how long, who can recall it, and over what time period, and what level of interest is being paid. So I want you to have it really sewn up in terms of the numbers and the detail. Now, the moment your company, UK company this is, starts paying out interest, it has to follow what's called a CT61 process. The CT stands for Corporation Tax 61 process. That usually means that if a company is paying interest to a real person, a flesh and blood person, in other words, if the lender isn't another limited company, it's a real person, and Max, you're a real person, then a CT61 is needed, and it requires once a quarter for the company to report to HMRC on a CT61 form what interest has been paid. And worse than that, you have to withhold 20% of the interest payment to you, Max, and have the company pay it to HMRC on your behalf. Now, there are some get out of jail cards on this. I do like that phrase, get out of jail. But there are some ways that you don't have to. You probably still need your CT61, but you might find a way where the limited company doesn't have to withhold the interest or 20% of it, particularly if you're based overseas outside of the UK. As always, the angels are in the detail. So you might need to do some research again with your tax advisor to get your head around that detail. Do not make the mistake of not following that process. It's just £50, it'll be fine. Please don't do that. HMRC will get very uppity with you. That's my next favourite phrase of the evening.
Yes, it's very good phrase.
And they could fine you. They could fine your company, rather, not just for not filing the CT61. It will also be a fine, unfortunately, for not having paid the right amount of withheld interest. So go get it checked out. CT61s are important documents.
And not only that, it's this extra administration. So one of the things you can do is, rather than do your interest payments on a monthly basis, quarterly basis, is do it on an annual basis.
Yeah, so the CT61 process requires you to file, a bit like VAT returns. If you do VAT returns here in the UK, you'll have any understanding of them. The concept is that you tot up the last 3 months' worth of amounts of money that you owe as a VAT payment, say, and then pay it in one payment, and also file one document. CT61 is the same. The difference is, if there is a quarter period where you haven't paid any interest, you don't file a CT61. You don't even have to tell HMRC. You just file it when you do. So that's really helpful to do it once a year, which is often the ideal way that many of our clients do it, because by then they'll know all of their numbers as to what else they've earned, to know whether they can add up to that magic £42,000 worth of income. So you can do it just once a year, which means you only have to file a CT61 once a year too.
Yeah, I think it's really important to notice that whenever we work with our clients, we do it at the year end of position of the company, and then identify the most tax efficient interest to charge, because we're looking at their personal tax affairs as well. So not only are we looking at the company, we're looking at the individual as well. So that's really important, actually. One other thing to bear in mind is that the interest, of course, is a cost to the limited company, so it does get the tax relief.
It's a double win-win in my opinion, because you're getting the income completely tax-free, and your company is able to set that interest as an expense within its profit and loss, which means it's going to help bring down the profit, which means it's going to bring down the corporation tax. Cha-ching again.
Yeah. I mean, by the way, if you're enjoying the show, then please do give this video a thumbs up, subscribe to the channel, but do me one other favor. If you know of a friend that's in business or in property, and you know some of this content is useful to them, send it to one person. Think about one person that you know that would find this useful. I'm not asking you to cast it in across your network, just the one person that you can help out. Please send it to them, because it could be really invaluable for them to understand what we're talking about tonight and the opportunities that they're missing by not being on this show tonight. So it's a bit of advertising, but equally you're helping a friend out. So why wouldn't you do it? Okay, so let's move over to Ola as our question, and Santosh.
Hello, Ola and Santosh.
So it says here, I've combined their names only because the questions were very, very similar.
Awesome.
So they said,
you're on a mind meld.
Yeah. Ways someone can mitigate higher tax liability apart from buying a limited company.
Via a limited company.
Via a limited company. So buying property or business activities. I have 2 properties in my own name, earning 60k from my job, and my wife is earning just below the basic income tax band. I have a special purpose vehicle, and I'm planning to buy future properties. Can I transfer the ownerships to the limited company, or can I transfer the rental income? That's a good one. To the limited company. So rather than just the property, can I just transfer the income and leave the property in my name, basically? I'm also thinking to make this limited company, the management agent hold 90% of the income. That's a no-no, isn't it?
So there's lots of opportunities in here. It's like an exam question. So quite frankly, these are some amazing things. I'm going to break it down, if I may, with Simon's help. So ways you can mitigate higher tax liability apart from buying in a limited company. I'm going to guess what is being mentioned here is buying rental property in a limited company. It's a really interesting comment, because I have a lot of people come to my tax sessions and Simon's tax sessions saying the answer is a limited company, isn't it? And actually, when we get to the nub of what the real question is, how do I make myself more tax efficient? I would say it's probably less than 6 of our every 10 clients that actually a limited company works out the right solution.
Yeah.
Lots of individuals, for all the right reasons, are missing some valuable tax efficiencies that mean that they don't have to spend hundreds, if not thousands of pounds maintaining their limited company every year. And they all walk away very happy, which I'm delighted about. That's exactly what we want. But there are lots of things that you can do to basically acquire assets and manage them in your personal name and do so tax efficiently. And we've kind of started to scratch that surface a little bit earlier with Simon's input to all the different ways you can earn up to £42,370. Ka-ching, ka-ching, ka-ching. But 2 properties in personal name and earning over 60,000, let's say, in your day job, well then maybe what you need to think about is how much below the basic income tax bracket is your good lady, because could you move some of that income to her through, and you might have watched one of our earlier videos. I feel like we talk about it every time.
Well, it's just funny how you should mention that, simply because I have just shared that link to transfer property income to your spouse if they are a basic rate taxpayer or a lower tax band than you. I've just sent that link, so go ahead, stay on this show. And then after the show, you can go away and watch that deed of trust, and it'll help you save thousands of pounds of tax. 3-minute video. Deeds
of trust, awesome tax efficient tool. So that would be one of the first things. So that's possibly the first question starting to be answered. The next question was, I do have an SPV company. Well, what's an SPV? Special Purpose Vehicle is the name it's given. Most of the time, it's just a very fancy phrase that unfortunately some people use to make it sound exciting and quite frankly expensive, and it doesn't need to be. It's a limited company, and in its Articles of Association, it has a very specific job to do, and in that Articles of Association, it explains what the job is it's going to do. And that's kind of, I appreciate condensing down a lot of what an SPV is, but it's a common and garden limited co with a specific job. And planning to buy future properties in a company, well, fantastic. If that's the solution that's going to work for you, limited companies can be a great solution for inheritance tax planning, even if it doesn't give you a short-term income tax benefit. So that could be a great solution. And can I transfer ownership to a limited company of my rental income that's not inside the limited company? I think the long and short of that is no. Unless your limited company is running what I call a rent-to-rent business, and that's all it does. In other words, it's taking lots of other properties it borrows from other landlords, obviously paying them a decent amount of money to borrow them, and then runs a rental income project and a business through those properties. Unless your company is already doing that, I wouldn't recommend it. There's an interesting piece of law called GAR, General Anti-Abuse Rules. And certainly from our opinion on reviewing that legislation, we feel that running what's called a rent-to-rent, so in other words, you owning the asset but lending it to your company, we feel it would probably fall foul of GAR, and you really don't want to be on the sharp end of a problem with HMRC quoting GAR at you, so I wouldn't recommend it. If, however, your limited company may be, for example, managing all the letting activity on your property portfolio, and legitimately it is your limited company that's running that activity, well, you would recompense any letting agent for their services, maybe not at the 90% of income, but if you go and check out market rate on a good quality letting agent in your local geography, well, perhaps you could match that rate and utilise that so that the company is charging you personally for the services, and potentially it's going to help minimise your tax.
That's hugely valuable, isn't it, in terms of being able to do that. So it's interesting when people talk about limited companies. You see so much stuff on Facebook, LinkedIn, friends down, networking sessions, even your property mentor that you've been educated. You know, it's almost the first go-to place. Set yourself a limited company up, and I just think it's wrong on so many levels. When you might be giving it your job, albeit don't do that, as I described earlier. Your spouse might not be working. You might be starting a young family. There may be so many opportunities for you to start to look at your income streams and saying, well, should I earn money elsewhere? Utilizing your tax-free allowances, as we described earlier. If you've not seen that, go back to watch that video, part of the video. So useful. £42,000 as a reminder, tax-free.
Plus 370.
Yeah, so £84,000 with your question, Ola or Santosh, one of you asked that question, well, we just described how you can earn that tax-free. So really, you've got to look at different facets before you use a limited company for sure. Great answer. Thanks, Louise, for that. Stuart's asked the question, is it better to buy a property in LLP to take advantage of capital allowances?
Oh, lovely question,
However,
Stuart.
goes on to say, how does it work with sideways allowances if you pay PAYE?
Now this is an interesting question. It's like you've set me an exam question. I couldn't be happier, Stuart. So in terms of buying property in an LLP, we've had this a great deal over the years with our clients thinking about capital allowances, particularly for things like furnished holiday lets. And I won't bore you to death with that. Go read Help Sheet 253 from HMRC. Literally Google HS 253 HMRC. Gives you lots of fabulous information. But I have a lot of clients over the years saying, well, what about if I buy it in my partnership, or I set up a partnership to do this particular business activity? And this particular type of activity, I can claim loads of capital allowances, and then I can sideways move them to my job. If I don't need those capital allowances to bring down my new FHL business down to a zero profit line, I understand I can move those losses, so to speak, against my property, my non-property income, and bring down my income tax on my job. No.
I do feel, though, when you say no, I do feel as though we've got to go to because years gone by, that was allowed.
2013, when I was 5, you could do that. Sadly, the world has moved on. I don't want to see any smiles from you there.
This is a live show. I really should smile. See?
Doesn't work.
No.
So, many years ago, you could have moved your losses against other forms of income in your name and got a lovely, lovely tax rebate. You can't do that anymore. And one of the things I used to say to my clients is if you're building a really profitable business and you run out now of capital allowances to save you paying any tax, you're going to be paying tax at income tax rates rather than a limited company and corporation tax rates. And often I find clients, when they start up this kind of business and it's going really well, that combined with their other incomes, such as interest or salary, pushes them into being at least a high rate taxpayer, in other words, earning more than circa £50,000 a year, which means all of that lovely income in the LLP is now being taxed at 40%. And it could have been being taxed at 19% in a company. So they've doubled their tax bill for a short-term sugar hit, for want of a better phrase. I don't see it ever working for most clients. If you're saying you're going to have a short-term activity in an LLP, and once it's used up all of its, so to speak, capital allowance losses to protect the profit from tax, you're then going to sell it and move on, maybe. Still, I would say go talk to your tax advisors.
I think LLPs are brilliantly used by solicitors and accountants because they are protected, because it's got this corporate protection, because it is limited liability partnership, but it has no benefits from a tax perspective. So people kind of get mixed up with that because they hear it's a company and therefore surely that has some tax benefits. It doesn't. It just gives you that protection. So really, is an LLP all that great? I heard some stories about you could buy a Ferrari. Trust me, you cannot buy a Ferrari in LLP and then just have it expensed. That was done over by HMRC in 2016, and someone's still spinning that wheel, even in 2021, which is some years on. But no high horse from me tonight. I shall pass on. Anything else to add to that, or are you happy to move on?
I think for many of our clients looking at LLPs, it's almost the worst of every world, because you've got to report it almost like a limited company, yet pay tax as though it's an income tax rate on a personally owned income. So for many clients, they don't actually benefit from that limited liability element of the partnership. They'd be better going to a limited company in those scenarios more often than not.
Yeah, no, fair point. Would you want to go to the live questions that have been sent?
Hooray.
So I want to demonstrate this as a live show. It's not a hoax, and we've just pre-recorded this and then sent it on. So I'm going to answer some of these questions, or Louise and I are. So we've got MD Lins. Hopefully I'm saying that right. So if a limited company is purchasing a property and also furniture in the property, can the furniture be expensed to reduce future tax liability? And that's interesting because I think we've got to look at the types of property.
I did a super article on this only a year ago, I think, where we looked at all this.
I'm looking at you blank here.
I remember it,
Yeah.
where we looked at how to expense furniture. And
Right.
it depended on what kind of property business it was that you were running.
Yeah, but to summarise though, I think in terms of expensing furniture that you have just purchased, I think it's quite difficult unless you are replacing. And some of the videos we've done is about allowable cost, where we're talking about replacing, repairing, renewing. All of those kind of costs can be offset against your income. We're not going to go into depth about that, but do look at that video, allowable costs, on our channel to learn more about that particular subject. But the reason I mention that is because if you are buying a property that's got some furniture inside of it, like a settee, and the owner said, well, can I just leave the settee? Then you buy a new settee, that is a replacement. So that can then be offset against your rental income. Absolutely fine. But what if you have a property, it's empty, and you buy a sofa? Can you offset the income? Cost against the income? The answer would be no. But if you've got a furnished holiday let, then you could claim
Capital allowances. How helpful.
So capital allowances then can help you to reduce your tax, whether you buy that in a limited company or indeed if you buy it in your own personal name. Either way, you can get a capital allowances claim against that. So very, very good question.
And don't be forlorn either if you're now thinking, well, this isn't a furnished holiday let and I don't have a replacement that I'm buying it for. Small sucker, I appreciate, but if you happen to sell that property in the future and that original piece of furniture is in the property at sale and you leave it as part of the sale price, then you'll be able to offset the original purchase price against the capital gains tax calculation. So it will, it's an expense that you're going to get tax relief on. It just might be at the end of the life cycle of ownership rather than at the beginning.
Yeah.
So you're not going to lose out. Keep those receipts, or better still, scan them and save them.
Suntox on the YouTube Live
Hi, Suntox.
has asked a question: can you buy shares in other companies within an SPV, not just property?
Oh, now if it's an SPV, back to my earlier point, what that means is that the articles describe what the business can do. If your business has been niched down to only buying property, you may find that you'll have to alter the articles to allow you to buy shares in other property businesses or non-property businesses. Be very careful though, because if you've been, I'm going to use this word nicely, forced by, for example, the mortgage company to niche in your business, so they've got some certainty and comfort that the kind of things your business will do will be very specific to property, then you might need to go and get agreement from them before you do anything like that. Anything to add?
No, there's a question to talk about moving properties into a limited company. So what I want to do is just share a video that we've done. So a question has just come in, funny enough, from Mind, Body, Soul Cleanse.
Oh,
so
nice name.
We could all do with a bit of that from time to time. And basically the question is, when transferring buy-to-let properties owned in personal name to a company, is there a good way you can suggest to save tax, i.e. stamp duty, land tax and CGT? That's a huge subject. So I hope you don't mind, but I'm just going to share a link with a video that you can watch to understand ways of mitigating that complex scenario and whether you meet those conditions as well. So feel free to watch that. I'm going to go to a different question then in that case. But Victor,
Hi, Victor
has asked a question: what would be the optimal tax structure, tax-wise, if the developer has joint venture contract with the owner and use monies from private equity firms to do the development itself? Would you suggest to have a JV developer and contractor companies separate? Many thanks. Any thoughts about that?
Oh gosh, I'm trying to get my head around the question. Sorry. So you've got you've got JV developer and contractor.
Yeah, and I think we can talk about it in the round as opposed to just the specifics.
Okay.
But Victor, if you listen to this and anyone else think about this, if you are developing a project, that carries a significant amount of risk. So if you're trying to mitigate risk, which we all should do, then you should have your property development inside an SPV, which stands for
Special Purpose Vehicle.
And as we described earlier, a special purpose vehicle is nothing more than a limited company, but it's specific to a project. And the reason for that is something goes wrong with that particular project, it could affect all of your assets. So if you kind of mix in that development with all your business activities, your property investment activities, you could be in real trouble. So I would always say, create yourself an SPV. Now, if you have a joint venture partner, then you could own equal shares in that business. No reason why you couldn't do that. If you've got a contractor that is the joint venture partner, you can either just agree to have 50% of the equity of that property or whatever share you like, or they charge you for the profits made on the project, and then they go away and do their own tax planning themselves. So that might be the easiest way around it. I don't know what your thoughts are.
I would agree. I think it's understanding what the levels of risk are, what the ways in which you're all happy to be recompensed for the work that you're putting in. And whether you want to, quite frankly, work together on the same share structure, or simply, if someone's not prepared to take the same risk, perhaps they are simply a supplier to that ultimate limited company, as opposed to a share owner within that organisational structure. So it sounds like there's a lot of discussion to be had about who's up for risk, who's going to require a minimum payment or guaranteed payment for their portion of work or effort or materials they're putting in. And perhaps that then enables a structure to come to life.
Before we move over to standard questions, Mind, Body, Soul, Pens, you're very welcome. I hope that video really provides some benefit. Sometimes come back with a question saying, we have heard so much about offshore companies. Is there a way that HMRC will be happy with offshore? Are you kidding? Are you saying that if you have your income offshore, therefore they get no tax at all, that they could be happy? Doubt it.
Maybe you could give us a little more background on that.
However, I was going to say, it are the ways of mitigating tax. It doesn't matter, by the way, if HMRC are happy. It's what's in law. So if you can find a way to use offshore companies to be tax efficient, it doesn't matter if HMRC are happy or not. Who cares? It's about you being tax efficient at the end of the day. So don't worry about them being happy. They're not going to be on the Christmas card list or anything daft like that. So you just need to think about it. But as Louise says, I'm not sure the type of offshore that you think about. HMRC are stamping down heavily on offshore companies as we speak. So do be careful. We saw this, the loan arrangement being quashed. We've seen some trusts being hammered by HMRC. So I think there's only one trust, offshore trust, that is still in existence that HMRC can't crack. And I think it's 1952 trust. I don't know why I remember that, but it was just part of the
way before I was born.
The case law, not that long. But it was an old trust, and many people can't use that trust type of trust anyway nowadays. So interesting. So let me just say I won't answer that. So let's move on to some of the standard questions that we've got, and sometimes you're very welcome. So let's go over to Will. Will's asked the question, I'm selling my home to a limited company. Now, before we move on to Will's question, what's the problem with selling a home to a limited company? Let's say it's worth £600,000.
Well, if you are selling your home and remaining in that home when it hits the limited company, then you're going to find yourself on the sharp end of potentially ending up paying ATED tax. So ATED is annual tax on enveloped dwellings, for those that are keen to know what the acronym stands for. Not that that helps you with understanding what it really means. But what it means is basically a company owning a residential property worth more than £500,000 will be on the hook for an extra tax every year. Happy days. And that tax typically starts at, I think it's about £3,500 for a property between £500,000 and £1 million. And it goes up as high as, I think the highest value is £350,000 a year tax bill.
Crazy.
Nice. So you need to be aware of that. And also, because we are talking UK taxes, the world doesn't work simply. You pay this tax up front every year. You pay it as a single payment, and it has to be paid normally somewhere between the 1st and the 30th of April every year for the period the 1st of April through to the 31st of March the following year. So, like I say, if you're residing in a property or anyone connected to you and the directors of the company are residing in that property, even for just one night, kiss goodbye to some additional tax due to ATED. Not nice.
Not only that, but I think anyone selling their property, their main home to a limited company, and if you're willing to, if you think about staying there, that's a big question, isn't it? Because here we could be thinking, well, are they looking to try and make some revenue out of this property to make it a buy-to-let? So the question probably wasn't, I wasn't clear on that. But if it's a home, I would never really transfer that to a limited company because of what Louise described. But there's something else, private residency relief. If you subsequently sell that property inside a limited company, it will be taxed at 19% on whatever gain it makes. So, and I know there's questions about, well, what's the value of the property when you move it to a limited company? It will be based on RICS valuation at that point in time when you do a transfer from you to a limited company. So a RICS valuation will be the value that it replaces in the company, irrespective of the mortgages. And after that point in time, any increases will be subject to 19% corporation tax, which we know is increasing to 25%, depending on how profitable you are from 2023.
Yeah.
And that, therefore, is an extra tax that you may not need to have paid if it is indeed your own home. Third tax which I've only just thought about, is inheritance tax, because you also get a residential nil rate band in addition to your £325,000 inheritance tax lifetime allowance. So when you die, any assets over 325,000 would be subject typically to 40% 40% IHT. However, if you have a home over and above £325,000, and again this doubles if you're a couple, you get this extra £175,000 potentially, depending on the value of the property, which means that that's tax free. So putting it into a limited company actually can be quite cumbersome from a.
Well, we haven't even finished on the taxes, because if you're a director of the company in which you've actually put the property and it remains your home, not only are you going to pay ATED, but you're also going to pay basically for not paying any rent on that property, assuming you don't pay your limited company any rent. It's going to actually end up as a P11D benefits in kind, which you're also going to have your company pick up national insurance contributions at 13.8% for as well. So it can become very, very cost ineffective and line tax ineffective to put your own property inside a company and remain in it.
Yeah. I mean, if you are going to move a property into a limited company, you have to also think about what is stamp duty land tax on the transfer, plus the 3% SDLT high rate, in addition to the SDLT banded rate.
Plus 2% if you're not based in the UK.
Yep. And you've also got the capital gains tax. If it's been in your home, shouldn't be a problem. But if you have not lived in that home 100% of the time, there could be some capital gains tax as well. So I don't really think that transferring a home, unless you're using a buy-to-let property, is a good idea. But even if it's a buy-to-let property, I think there just are far more tax-efficient things to do other than transferring property. I think you're just paying tax for no reason, if I'm totally honest with you. Will's asked a couple more questions. Saying, I usually do overnight viewings, trips with my partner. She helps with viewings and decisions. Just be a bit careful with that, and I'll get Louise to describe that in a second. But she is not a director or shareholder, which is where the problem is. Can I claim the full meal cost or half? So let's talk about that. So in our business, and this is really pertinent to what we're doing. So right now we are sitting inside of a service accommodation, which we paid rent for.
Yes, it's not ours.
So it's not ours. But we are literally a stone throw away from our apartment. But it's got to be refurbished. We've just got the keys today, and we've got the flights and the service accommodation paid for, which we can offset against our tax bill. Because when that property starts to, I'm pointing that way because it literally is that way. Once that starts to generate an income, the expenses of pre-acquisition costs can be used to be offset against that property. Now, sometimes you have to think, well, if we, and this is a good question for us to think about, is if we are doing pre-acquisition costs, is it capital or is it revenue? So that's a good question, because it's not maintaining, it's buying a property. Therefore, I believe it's going to be capital in nature. Because you're buying that property to get into that state, so it has to be capital. But if I was to come back out to see the property, maintain it, inspect the property, do whatever it is, whilst I own the property, then that cost can still be offset against my rental income on that furnished holiday business. So there's two aspects to that. But Will, to answer your question, my partner has no real deal. I appreciate you say she has dealings. But we've got to be honest here, and when we look at HMRC, just look at it and go, if you was in court and you've got to stand there, not sweating, totally cool, and you say, well, my girlfriend's there or my partner's there, HMRC could just go say, you were on a jolly. And you're then going to start sweating, right? Because you know full well that's what it is.
Maybe you won't.
Maybe you won't.
But you're a great poker player.
Yeah.
What I would say to you is that unfortunately you can expense for your portion of the business trip, but you can't expense that for your wife. Imagine you were in, and I don't know whether you do have a job as in a salaried role as well, but imagine you go away for business and your partner is there for support and administration, maybe in the background as well, just making sure you're organised, ready for whatever the business you're doing somewhere else is. You're not going to get her costs covered or his costs covered, unfortunately.
But why not make them a director? I just think that if they are really involved in the business, or maybe they aren't.
You took the words right out of my mouth.
But I think it's about making them a director, making them a shareholder, because ultimately we've described already that they can get tax-free £2,000 worth of dividends. Free. but why aren't you making them a shareholder in your business if they are indeed helping you out in your business and it's not some sort of, you know, good way to get a holiday off HMRC, which they will see through. But if you make them a director or shareholder, then it's harder for HMRC to argue against it because they're part of that business. Meals, by the way, there is an overnight rate. You do have to do some research on this because Mohammed in my tax team, actually, he taught me a thing only 2 weeks ago about there is a rate for international travel. There you go. So there's a rate of £25 per night in the UK, but in Europe it's different. So you do need to find out which country they're talking about. There are different rates for every country, and you can get your breakfast, your lunches, your evening meals. There is an allowance, so you couldn't go out and spend £100 on a meal and get that all expensive. It will be a limit. So just bear that in mind whenever you're doing that. But hopefully that's given you some things to think about. But Will, again, do you think about your tax structure? If you're a partner, could you make them a director? Could you make them a shareholder? Are you missing out on so many opportunities that the small question now becomes, can I get the travel expenses paid for? The big answer is change the structure of the company, I would say. Will's asked a third question saying, I missed the tax year deadline to buy trivial benefit gifts. So this is the £25 typically.
Yes.
£300. So anyone listening, your limited company can pay you £300 worth of gifts outside of, which is another part of the.
I knew he was going to go off on
a tangent. You've missed the.
So back to the £42,370.
Oh.
Your company can provide you with up to £300 worth of vouchers per director per year.
Yeah.
You need to be careful. It's not a single amount of £300, no more than £25 at a time. Ideally, once a month probably is the best way to do it. So that now moves it from 42,370 to 42,670. There you are. See, I didn't even need a calculator.
Well, it's not that. We have to also thank our guests to bringing that back to our attention, because without you, Will, we wouldn't have just given that £300 benefit to everyone listening in. But what we need to remember here, Will, is trivial benefits thing. It's in the tax year. So if you missed it in the tax year, you can't really pay them double, because then the whole thing becomes a tax benefit in kind. So be very, very careful with that. Some accountants might say you can go back or you can do this, but then you've got to reopen your tax return. You haven't actually paid it. Could be under scrutiny. So don't do it.
There are certain tax routes you can time travel, as I described it, but unfortunately this isn't one of them.
Yeah.
Sorry.
So that's the questions that we had set. So let's have a look at, we are out of time actually. So let's just see.
No.
Everyone said thank you. Everyone said thank you. So hopefully, guys, you really found that useful. I think the £42,000 is absolutely fundamentally brilliant.
42,670.
Yeah, it's such a big amount of money. So hopefully you guys learned a bit from this show. But again, please do give this a thumbs up. That would really help the YouTube algorithm. Do subscribe to this channel. And remember that one person, that just one person that you think could find this useful, please share the link to this video. It will help them and it will make you feel good tomorrow morning. Trust me. Why not try it? And then if I'm wrong, you send me a comment saying you lie. But anyway, apart from that, thank you ever so much for joining me and myself, Simon Misiewicz, and
Louise Misiewicz. Thank you very much.
And we'll see you again very soon on another live show.